We know the grid is undergoing massive change, which creates massive opportunities for local energy. The Energy Changemakers Podcast offers rich conversations with industry leaders to help you and your company capture opportunities to build the decentralized grid. I'm your host, Elisa Wood. Welcome to the Energy Changemakers Podcast. Hey everyone, I'm Elisa Wood, and this is the Energy Changemakers Podcast. Thanks for joining me today. We're going to talk about the economics of community solar projects. We're going to look at how developers and operators make money from these projects, and also how customers save money. So I've been fascinated by community solar for a long time because it seems to offer just a lot of wins. If you are living in an apartment or your roof is shaded, it offers a way for you to participate in a clean energy project. It's, of course, helping us with our climate goals. Customers usually save money, as I said. Usually your electric rate goes down if you're part of a community solar project. And clearly, it's a good business. Clearly, operators and developers can earn a healthy return because we're seeing so many of them in this industry now. So many projects are being built, and it's a vibrant market. We're seeing portfolios of community solar projects getting acquired. So how exactly do the economics of community solar work? When I started asking myself this question, I realized I had to talk to Rob Hung, who is the founder of Sapling Financial Consultants. Rob is a friend who often spoke at our conferences when I was the editor of Microgrid Knowledge. And he'd answer questions like this, ones that really demanded a lot of clarity and depth, and he just did a great job of it. So let me tell you a little bit about his company, Sapling Financial. It's a boutique consultancy. It offers investment banking, quality financial modeling, data analytics, outsourced FP&A, and due diligence to private equity portfolio companies, mid-market businesses, and scale-ups. Today, Rob is going to walk through the economics of past community solar projects. He's going to do so from the perspective of each stakeholder. So he's going to discuss the financial benefits to each party, how the end users share in the benefits of community solar, the costs of developing a project, including the costs paid to the developers. He's going to talk about the ownership versus subscription models and other financial benefits of these kind of projects. So I think if you are a community that is thinking about putting together a community solar project, you're going to find a lot of the information in this podcast really valuable when you're trying to evaluate what to do and how to move forward. I think if you're somebody in the energy industry who's thinking about developing or operating community solar projects, you too will find this information very useful. So let's get started. Welcome, Rob. It's so great to see you again. How are you today?
Yeah, thanks so much for having me. I'm good. How are you?
Excellent. Excellent. I'm just so glad you could come and talk to us about this because I think community solar has just it's becoming huge. I mean, you and I used to talk about microgrids a lot, and I would say that community solar is the hot topic of the day now. So I know you've been crunching numbers and looking at this issue and looking at publicly available data, and you've got some interesting insights to share with us. So I'm going to let you take it away.
Yeah, thanks so much. So I thought to start off, we would talk a little bit about what community solar is and some of the benefits associated with it. And then we'll get into some of the findings that we had as we crunched the numbers.
Excellent.
So community solar is basically a method to give equitable access to solar energy. And it helps end consumers who don't have the ability to install solar on their own property access to the solar energy. It's a rapidly growing model of solar development in the US. And it uses the opportunity to subscribe or take ownership in a solar array in the community. Obviously, right out of the gates, it's important to note that if somebody has the option to build a solar panel or kind of solar array on their roof themselves, with community solar, you're adding a whole bunch of intermediaries who each of them have to be compensated for that. And so right out of the gates, this is not something that someone who has the option and the capability in terms of financing would opt for in place of putting it on their roof. But for those who don't have that option, who want to generate some savings, who are interested in contributing to, moving to a carbon neutral economy, this is a good option. So right out of the gates, I do want to put that there. It's not superior from an economic standpoint to having rooftop solar, but for those who can't do it, it is a great option.
And it's a great option, I understand, for like low income communities or programs which are trying to bring down costs for community electricity costs. It's one of the programs that's being used a lot, I think, with some of the Biden administration money.
Yeah, and I think it is good when it's doable. One of the issues that we found in our research is there are often developers or operators who are looking for a minimum credit score, like a FICO score of 700 plus, which is a pretty solid score. And that's not always going to be something that people with a lower income will have. So there are groups and nonprofits and developers who prioritize that and are willing to accept some lower credit risk. Obviously, they're going to have to make the numbers tally. They're going to have to do other things behind the scenes. So maybe the savings get squished a little bit. But yeah, insofar as it's available to lower income communities, it is a great thing. I do want to talk a little bit about the community solar itself, and then we'll jump into kind of what we did for modeling the different return profiles across three different groups. That's the developer, the operator. Sometimes there's no operator, the developer is the operator, but the operator is a second party we looked at, and then the community or households themselves.
So developer, operator, end user, customer. Okay, got it.
Exactly. So the developer is the group that builds the solar farm. So they're the ones that take the risk of bringing together all the different parties, the landowners, the engineering firms, the suppliers of solar panels and all the supports. And they're also the ones who will interface with the community, interface with regulators, utility, everybody. So they're the ones who really get the ball rolling. In many circumstances, and the example that I want to walk through, the operator is different. A different party will go and purchase the solar farm from the developer. So developers really only in it until they can get it kind of across the finish line when it's able to begin generation. And the operator, different skill set, different mentality, different return profile. The operator will take over and they'll be the ones that interface with the end consumers. And then the end consumers are the third group. And so they're the ones whose job is to purchase the energy or purchase a share in the community solar through a predetermined kind of ownership or subscription setup.
So if I'm a community that would like to have a community solar project, my first step would be to find a developer. Although I assume probably developers are more likely to find the community because they know where the applicable projects are, where places where projects will work. Is that correct?
Yeah, exactly. So the developers will constantly be scouting out for states and municipalities where the grid price is already high. And so if they're delivering something from 5 to 20% savings, it'll be a lot easier for them to kind of make the numbers tally if they're going into those jurisdictions. I think, there's some states where they're very low electricity costs. You can RFP until the cows come home, but you might not be able to attract a developer, unfortunately. So the nice thing about this discussion is it's a commodity. And so all the price points are pretty clear insofar as that kind of per kilowatt hour received by the end customer is concerned. But that also means that like some areas just are not amenable to setting up community solar. And then you have all the other issues around constraints with the net metering and constraints around the state legislation.
Yes, we recently wrote about what's been happening in California, which you would think would be a great place for community solar, given the high price of electricity, but some of the net metering and other issues are getting in the way.
Yeah, it would be an area we would expect it to be better with the high electricity price, but the states that are leading community solar are kind of further to the east.
Yeah, we hear a lot about New York. New York as being one of the prime places. Again, it's got right policy and it's got the high electricity prices.
Exactly. So it's definitely a spot that's been doing better in terms of developing community solar. So if we look at what the benefits are of community solar, we already did talk about greater household savings. In terms of the research we've seen, like savings tend to range between 5 to 20% of annual electricity costs. How the community solar project ends up passing that savings on to the customer can vary in different ways. A lot of them will kind of take the face rate from the grid and basically just guarantee knocking off a certain percent.
So if I'm paying X cents per kilowatt hour, they'll guarantee a certain percentage off of that.
Exactly. And so they'll kind of move in lockstep with whatever the grid is delivering. So that's one benefit is the savings. Another benefit is, as we mentioned, the low to moderate income household access. Heavily caveated in the sense there could be credit score issues that will disqualify some low to moderate income households. But if you compare the option of community solar versus rooftop solar that's owned personally, there are significant financial obstacles to that, which are less clear and can be surmounted under community solar for low to moderate income households. There's also, depending on the setup of the community solar, it's possible that there can be increased resilience to the household directly, or at least to the grid, but that's going to be watered down significantly compared to having your own rooftop solar. Like if it connects to the grid and then there's a power outage from a line between, you and distribution, like obviously having community solar is not going to help too much.
Oh, so this is interesting. So, but there could be some resilience. I always thought of it. I thought it was like rooftop solar, where if the grid's down, you're down. It wouldn't provide any kind of backup. But you're saying it could provide, in some cases, it could provide some backup.
I think it just depends on the structure of the project. There's so many different types of structures, and we'll talk about that a little bit more as we go through this in terms of what the developers are doing. But I'd say generally it's more of a grid benefit than it is a direct household benefit. Another benefit is the community ownership. And again, there's a huge range of ways in which this is reflected. But in many circumstances, attracting the developer, selecting the developer for the community solar is where that community engagement begins. And then the project itself can often offer voting powers and governance powers to community members. So again, depends on the structure that's set up. And then there's often benefits associated with it. So in exchange for approving the community solar development, the developers, just as with like a real estate project, can often say, "Oh, we're going to help you with building out a park or something like that." So it all depends on the specific project, but there is an element of community ownership beyond just kind of owning, a share in a solar farm. There's also the opportunity for equitable workforce development. And so given that the development is happening around the community, there could be, clean energy related jobs that derive from this. And then, as I already mentioned, kind of community engagement all the way from the selection process of the developer through to permitting and starting up. So in terms of the ownership models, there are really kind of broadly two different ownership models for community solar. One of them is a direct ownership. And so in this case, the participants will purchase a portion of the solar farm upfront and directly own the portion of the farm and the energy produced. So for example, if the participants purchase a block of a solar array for $2,400 per kilowatt, then they'll receive the value of the unit's energy production annually. And so they can apply that. And again, it depends on the billing structure, but they can apply that as a credit against their bill from the grid. And in some circumstances, they can also receive dividends or distributions to the extent that there's any surplus realized by the solar plant. The other option is subscription. So in this case, the end user is going to receive credits towards their electricity bills based on the energy their share of the system generates. Again, lots of different ways of setting this up, but one example that we've seen is the participants pay $5.28 a month to gain access to solar energy produced from a 50 kilowatt hour solar block, and they have flexibility to unsubscribe at any time.
So the participants pay to be part of it? Am I understanding you correctly? Are they paying a premium above their electricity cost through a subscription model, or is it a payment that guarantees a discount from the electricity rate of the utility?
We've seen different arrangements, but generally the participant will be receiving a discount relative to the rate that they receive from the grid. Very few people will be entering this arrangement if they're not going to be right on the face of it seeing a discount from the grid, but there could be risks associated with it, like if it's kind of an arrangement where they you contract for 20 years and there's either flat per kilowatt hour price or escalation over that 20-year period, then it's possible that the grid will become more efficient. And then you're going to see, negative savings as the grid becomes more efficient and you're, stuck in this contract that has a gradually kind of inflationary escalating per kilowatt hour cost.
It's important to note here, too, that this is different from what some utilities offer, which is called shared solar. And that is truly you're paying a premium to be part of a solar project. It's above and beyond your rate. So I think people get confused sometimes. They confuse shared solar and community solar. So that's an important distinction. I have a question for you here. On the surface, I'm thinking, looking at this, that as a consumer, the direct ownership model would be better for me. Is that actually the case? Do the numbers actually bear that out?
I mean, that's a great question. I would say on average, yes, you are better off having direct ownership because then you're going to gain or lose from the project as an owner. And generally, with owning these assets, like the expectation is you invest in them and you can make money off of them. And so you're kind of like a mini developer who's tagging along. You're able to purchase a share in the community solar project, and you have the opportunity to gain from it. If there's extra production, then you're going to benefit from those extra credits. But you also have the opportunity, if you want to call it that, to bear losses. And so if for some reason the solar project is damaged and the insurance doesn't cover it, then you're going to bear that loss as well. So, I mean, all else equal, if you have the money up front in order to be able to purchase those shares in the project, then yes, the direct ownership will tend to be better, but it's less. I mean, you're an owner with all that entails. And so if you're just in it to realize a 5 to 20% return, which might be less than what you would get from direct ownership if everything's working properly, then subscription might be more beneficial. But the big distinction is in the direct ownership model, you need a whole bunch of cash up front to pay for it. The subscription, you just pay a regular monthly amount.
So you buy into it with an upfront payment if you're a direct owner. And if you're a subscriber, it's like a magazine subscription. You're paying a monthly fee.
Yeah, exactly. And so if you're doing the direct ownership, if we compare the whole community solar to rooftop solar is like full direct ownership. Community solar, you water that down a little bit. And so you still own the asset, like your percentage share of the asset, but then there's also like an operator who's running it. So, some money has to go to them. And there are other owners as well. And if there's, governance issues, then that can kind of be a little bit less work than if it's like a condo board, but you're also you're owning it alongside other people. And so you're watering down the benefits compared to owning rooftop solar. And then if you move to a subscription model, you're watering down those benefits yet further. The savings are commensurately lower, although in some respects, you're taking some of the risk off the table with the subscription model because you don't have those risks associated with being an owner.
That's very interesting because we often talk about the concept of, sharing in energy wealth. And you bring up a good point that your share in the energy wealth will also increase your risk in the process.
Yeah, exactly. So before we kind of talk about the economics associated with the developer, operator, and household, there are a couple of costs I want to discuss. So for the developer, and from my understanding, this is a relatively unloaded cost, so not kind of burdened with soft costs and a whole bunch of other things. A solar farm will typically cost between $890 to $1,010 per kilowatt to install. It does depend on the type of solar panel, with longer lasting ones costing more. It also doesn't include the cost of land. And for community solar, that land is often leased. So that's a major cost associated with the developer. For the operator, the major cost is operating and maintenance costs. And those are typically, based on our research, around $14.36 per kilowatt per year. And then there are other potential costs as well, like insurance costs that need to be layered on top of that.
So on the first one, the developer, when we're talking about the leasing of the land, are there situations where a community doesn't have to lease land? For instance, if you had a community solar project on a high school campus or something like that, would that perhaps reduce your costs?
Yeah, it would reduce the cost for sure. And that commensurately, all else equal, in a perfect market, that those costs should result in a lower per kilowatt hour amount charged to households. And I think we kind of alluded to it already, but like one of the discussions is that there might be outsized gains that accrue to developers and operators relative to households. And I think if there's lots of competition, then you're going to get to the point where the developers and operators are competing in order to be able to pass along the highest amount of savings. If there isn't a lot of competition, then the developer and operator might not pass along those benefits to having that posted on like public land without a fee. And so if it's a situation where, you're recognizing with community solar for a specific community, you're probably not going to have two of them. It might make sense to play a little bit of hardball to ensure that you're achieving a fair deal, because my firm spends all day building financial models, and it's just so easy to, I guess, lose track of like, oh, you gave me this and the imputed value is this, so I'm going to go and pass along this amount in savings to you when we set up the subscription. So I'd say yes, it can be done, but I think a lot of our clients are developers and operators. So recognizing that, like, I think all parties should make sure that they're trying to trust but verify and negotiate what's a fair outcome, as opposed to just kind of maybe getting a little bit too excited and passing along benefits that, maybe we're not required from the developer's business case.
So it sounds like too that you might want to, if you can, go out to bid for your project.
Yeah, absolutely. I think you should go out to bid. I wouldn't necessarily just sole source it. It's a huge investment. It's a huge amount of dollars. And yes, the investor, if it's a subscription model, the developer, the operator, the investors behind them are the ones putting that money in, but they are expecting to get that money back somehow, one way or the other. Nothing comes for free. So I think, create a little bit of competition and make sure you're getting a fair deal. And obviously lots of developers and operators who are ethical and looking to get a fair deal too. But those ones do need to be paid as well. They do need to make their required returns.
Yeah, of course. Yep. So you're looking for a fair deal where everybody gets a fair shake, basically.
Exactly. So, and in the circumstance where you consider gifting the high school land, I would say, maybe you can ask the developer to share the financial model, have a third party firm look at it, and assure yourselves that all else equal, the gift of the land is passed on, and that can be verified. Relatively simple if you have the financial model, or if you can collect some items from the developer and build your own kind of shadow financial model. And plus and minus is always, it's not going to be perfect, but you should be able to quantify the value in terms of reduction in dollars per kilowatt hour from gifting that land versus kind of achieving a market rental rate for it. So in terms of setting up a model to evaluate the returns for each parties, we went into the Sharing the Sun Community Solar Project dataset from the National Renewable Energy Laboratory, NREL, and we selected a Cherrydale solar farm. So this is a solar farm, a community solar project located in Northampton County, Virginia, capacity of 20 megawatts. The developer is a firm called Hecate Energy, and then the operator is a company called Dominion Energy that acquired the asset from Hecate Energy in 2017 for $40 million. And the grid in question is A&N Electrical Cooperative, and the electricity from the community solar was sold to A&N through a power purchase agreement. And A&N offers its members access to the solar energy through a community solar program called Cooperative Sunshare.
So there was a developer, and then the developer sold the project to Dominion Energy, which is a utility, and that utility is operating the project for the customers of the electric cooperative, A&N Electric Cooperative.
Exactly. And so I'll speak in a little bit more detail about each of these returns. You can think of kind of a spectrum in terms of return and risk. Higher risk means higher return means higher risk, and conversely, lower return means lower risk. So if we kind of stack them from left to right in terms of high risk to low risk, the developer is the one with the highest risk, the operator is the one with the second highest risk, and the end consumer is the one with the lowest risk. And so in our analysis, the developer comes up with a 21% IRR, the operator with a 12% IRR, and then the end consumer, we can't do an IRR because there's no negative cash flow at the beginning, but the kind of corresponding numbers, we come up with a 4.7% annual cost reduction. Now, there's a ton of assumptions in our analysis. We can't get the books of developer or operator, and we can't really get the specific bill of the end consumer. And so there's a lot of estimates involved. But 21% return, a 12% return, these are good returns today. They were even better returns when you compare to market interest rates at the time the project was developed. There are good returns, but I do want to caution that we have the points that we pulled from publicly disclosed items, but there's a lot of gaps that we need to fill in. And your experience may vary in terms of a lot of the costs associated with developing and running these projects. So I'm not going to go out there and put my name on these numbers and saying this is what we think they actually achieved. But I will say, based on a reasonable assumption, these are probably higher range estimates of what they might have achieved.
And what year was this project developed?
2016. It was developed. In 2017, it was sold to Dominion Energy and production started.
So is a 21% return typical for a clean energy developer? Is that in a common range?
I'd say it's towards the higher end of what we've seen. We've seen returns that are kind of as low as 6 to 8%, some lower, but that's, I don't think that's intentional. I don't think anyone goes to market with those. 21% is definitely higher. If we kind of make the assumption that the developer's receiving 21%, then the operator's receiving 12%, it's not like we can add those together and say, oh, the overall project return is 33%. No, it's more that the overall project return is somewhere between 12% and 21%. So if the developer just held on to it the whole time, then maybe they would have come up with like a 16 or 17% return. But they probably got to market at a good time and managed to achieve a fair deal or a great deal for them when they sold the project.
And that's a pretty nice return for the operator too here. Is that typical for a solar operator?
Again, I think it's a little bit on the higher side. But I do want to caution that, we've had to pencil in a lot of things. And as we go through the analysis, I will clarify where I think, the base case assumptions which we made, which were reasonable, still might be a little bit aggressive. And so there is downside. And so I do want to emphasize that, these numbers look really good, but that's in many respects after the fact.
The numbers come with caveats. I got it. Yeah.
Yeah, heavy caveats. And I will also add that if these numbers are looking strong, I think that to me indicates that there's not enough competition in the space. And to the extent there's competition, those numbers will be competed away. Obviously, electricity lends itself to a natural monopoly, but I think with community solar, given that they're connecting into the same grid, there's not necessarily a reason that a grid can't have multiple community solar providers. And so if that can be set up properly, while overall electricity might be something that kind of is regulated to a specific return, I think here we can achieve some level of competition that will bring these IRRs in a relatively short time frame within the right markets to something that's maybe, I don't think 8 to 10% probably would have been what would have been a solid but not fantastic return at the time of the project development. That's gone up a little bit now because prime rate 8% or so.
Yeah, I'll say too that I'm in Virginia, and I don't think in 2016, 2017, there was much competition in community solar. In fact, they're just starting now to pass some rules and policies that are really encouraging community solar.
Exactly. And given that was a little while ago, 20% IRR maybe for a solar project would be considered high. But for taking the risk of doing something completely new and having to interconnect and work with the grid and expend legal costs, just push through something where the regulatory regime was much less mature. I mean, first, maybe they end up incurring a lot more costs, which would bring down that IRR. But second, if they're pioneering it, then the net IRR might be something that we should celebrate in a sense, even as we hope that subsequent developers see that number fall a little bit.
Good point.
So if we look at the project economics of developer Hecate Energy, the IRR of 21%, how do we derive that? The project to build Cherrydale was approved in August of 2016, so it took about 15 months to complete. Per NREL, the average cost for utility-grade community solar in 2016 was $1.54 per watt. In 2022, if we did that for inflationary purposes, that'd be $1.88, but our number is $1.54. So based on 20 megawatt capacity, that equates to $30.8 million investment. Now, I brought up a number earlier where we had a cost per watt that was lower. That one, my understanding, is not loaded with soft costs and all the other costs based on loading and all the different costs associated with getting this up and running. But again, we didn't put the $1.54 per watt is much closer to what the developer could have experienced. We didn't really put too much to adjust for what might be significant legal and regulatory costs, among other things, to get an earlier project out the door. But assuming it's $30.8 million, they then sold that project in November of 2017 for $40 million. And so if we just do a really basic IRR calculation, so cash outflow of $30.8 million and then cash inflow of $40 million just over a year later, then we come up with an IRR of 21%. And if we apply an 8% discount rate, that's a net present value of $5.41 million.
Thank you. That's great. I just want to let our listeners know, too, that Rob has very kindly sketched this all out in slides. So if you're frantically taking notes, we are posting the slides in the community. You can take a look at them there.
Yeah. But as I mentioned, I don't want to give that number without mentioning the risks. There are significant risks in developing these projects. There's potentially interconnection delays, which could delay the project. There's regulatory complexity, which could increase legal costs. There's material price volatility. So, we all hear all the time about construction projects that have cost overruns. Some of those are borne by the contractors, but there's usually clauses that allow them to pass some of that on. And so the the developer is subject to that possibility, and that very well could have happened here. We just don't know, to be honest. And then there's also a risk of, if the developer went in with the idea, we're going to approve our business case based on flipping this thing in a year and a half, and there's no seller with the right price, then they might not sell it. They might take a long time to sell, and that completely changes it. So, in retrospect, if they achieved a 21% return, great. That's really good for them. But there was certainly not that certainty going into the project that that's what the outcome was going to be. So I want to recognize the risk that was taken in order to potentially achieve that return.
I'm also thinking as you're talking about risk, there's risks for this project, but these developers also aren't able to develop every project they start. So for their own kind of look at returns or their own internal financials, they have to consider the fact that this might be a great return here, but it may be offset by a failed project elsewhere.
Yeah, that's a great point. I mean, it's not as bad as with like venture capital where they expect 10 times returns on every single company and most of them completely fail. So it's a full, loss of that money. I mean, the returns in this space are, 20% is a great return, but it completely pales in comparison to the 50 or 100% or higher IRRs that like a venture capital firm would receive. And so, everybody looks at this from a portfolio perspective. And that's a good point that, okay, this might be a win, but if we looked at the full company's IRR on all the capital deployed over a period of years, it might be 10%, it might be 5%. It could be something that, we wouldn't be saying, these developers are making too much money. We'd actually feel bad for them and kind of hope that they'll push through it so they can achieve some projects that are a little more profitable instead of just, throwing in the towel. So
that's a good point.
So with respect to the operator Dominion Energy, we leveraged a model from the University of Massachusetts designed to help communities and municipalities plan for solar development. So we took that template and then we plugged in a number of different assumptions. So I do want to walk through those assumptions just so everyone's aware of how we thought about this. So first assumptions, the installed solar cost, we selected $2 per watt. That's based off of that $40 million purchase price. The solar array capacity, 20,000 kilowatts. Federal ITC, we assumed of 26%. The operator net revenue rate, and so we already provided an example earlier on of $50.28 for a 50 kilowatt hour block. So that works out to about 11 cents per kilowatt hour. So we assumed that in the model. And then we assume that the rate that the operator will receive will escalate at 2% per year. We've also built in a few costs. So in this case, we haven't assumed that the land was gifted. So there is a land lease payment agreement annually of $13.5 thousand per megawatt, as well as a payment in lieu of taxes payment of $2,099 annually per megawatt. We also assumed that, like all good projects, after the ITC reduction in the project cost, 40% of it was funded with a loan, with an interest rate at the time, 8% and a 15-year term. In terms of the performance of the asset, we assumed a net capacity factor of 19.4%. So that means if every single solar panel was generating its full capacity, then over the course of a year, the asset would deliver 19.4% of its total potential capacity. And so that would include adjustments around, obviously, at nighttime it doesn't generate. Obviously, it's not always fully efficient. The sun fluctuates. There are colder months, warmer months, and so on. So we've made that assumption. We've also assumed that each year the production will degrade at a factor of 0.5%. And the project has a useful life of 25 years, after which we kind of ignore what happens or just assume it's kind of kaput at that point. So 10 years after the end of the loan. We've also assumed operations and maintenance cost of $15 per kilowatt per year and an escalation rate on that of 2.5%. Now, I do want to say we've implicitly assumed that of that 19.4% net capacity factor, that all of that is sold at the 11 cents per kilowatt hour. And that might be an aggressive assumption. I know that community solar, they do tend to line up as much as they can before they launch, but there's no guarantee that they're going to have that full capacity kind of spoken for at the beginning of the project. And then there's furthermore no guarantee that as the project continues, that all of those people will continue to be paying subscribers. So when we crunch the numbers on that, we come up with Dominion Energy, the operator, receiving an IRR of 12.1%. with a payback period of 8 years for operating the Cherrydale farm. So that equates to an NPV, or net present value, of $4.72 million with a discount rate of 8%. We also did a quick analysis that I thought was helpful. If the project only sold, Like if it only sold 60% of what we expected to generate, then they would receive a 0% IRR, which would, yeah, it sounds like it's a wash, but it's actually it's a lot worse than a loss because there was a whole bunch of interest payments that were made over that period that are sucked out of it. So they need to sell, a significant amount. And we talked about kind of 50 kilowatt hour blocks. Like that's a tough go. If the customer can cancel at any time, that's just not a lot of money that you're selling. And so there's a lot of risk on the operator to make sure that the asset is fully utilized in order to achieve that 12% return. So I think that's kind of a bit of an umbrella in terms of what we think they achieved. It could have been quite a bit less. Finally, for the end consumer, we weren't able with ANN to clearly determine exactly what the cost savings would be. So we took another community solar project where we had very much clearer economics, and we calculated there would be about a 5% cost reduction that the end consumer would receive. So if we think again about that risk versus return, higher risk accrues to the developer, lower risk accrues to the consumer, and likewise the return. And so as I kind of mentioned at the beginning, what you see is if you have rooftop solar, that's kind of the be all end all. Community solar, first the ownership model, and then the subscription model, you see a watering down of those benefits. And again, all the different parties need to be paid. They need to receive the return in order for all of this to make sense. And so that's why you see it. But in the event that you're not able to build rooftop solar, community solar is it's a nice option.
Very interesting. So I have a question on the consumer side. Are these savings pegged to the price of grid power over time? So what I'm trying to ask is the idea that the electricity rates are going to rise over time considered when we calculate these savings?
Yeah, that's a great question. And it really depends on how the project's been set up and what the operator decides to charge. Some of them, it will be like this $5.28 for a 50 kilowatt hour solar block subscription. So in that case, if the grid all of a sudden becomes cheaper, then you might be in trouble. For others, it'll be kind of just pegged to it. So it's like, okay, we're always going to generate a 10% credit on your bill. And so in those cases, it'll fall. Now, obviously, if that happens, it's really great it's not necessarily really great for the consumer because they could receive all the benefits less that 10% if they had just stayed grid users, but it's really bad for the operator, the developer, because they have this asset that they invested all the money in, and there's not much they can do. They can't be like, the price per kilowatt hour has dropped from 12 cents to like 10 cents, and we had built the model based on 12 cents less 10% to get 90% or 10% savings for the end user, and now we're at 10 cents and directly receiving 9 cents. Like they didn't build that into their business case. And so it's really bad for them. And there's just not much they can do about it. They just have to honor the agreement they set up. So,
but our chances are that the rates are going to go up, grid rates. I mean, I keep seeing all these utilities talking about demand is rising. And
I think they usually, they usually do go up, but they don't always go up.
Good.
So it depends on the structure. And I mean, I guess if I was somebody who was subscribing to this, I would go for a structure where I achieve like a percentage savings against the grid. I'll always feel better about that because I can say, well, I could have been paying this amount, but I've saved 10% off of it. Most of us think that way. Whereas if you're kind of paying a fixed fee or fixed per kilowatt hour cost and there's an escalation, yeah, there's a possibility that the grid costs accelerate and you really feel great about it, but there is the possibility that they slow down or they drop, and then you'll have a bit of buyer's regret or buyer's remorse, which you simply won't have if it's just pegged to the grid cost.
And I guess most people aren't really tending to pay that much attention to what grid costs are doing. So
no, they aren't, and that opens up a whole can of worms with respect to how a lot of these things are billed, and often you end up paying a certain amount for the community solar company at 90 cents on the dollar, and then you receive a full credit back from the grid. And then in months where there's kind of lower production, you end up doing like more poorly compared to months of higher production, and that you can only figure out how you did it at the end of the year. So it can get kind of messy with that, and people aren't paying attention to it. So again, back to what I said, all else equal, I'd probably opt for one of those ones where it's just pegged at a discount to the grid.
Yeah, that makes a lot of sense. Great. Well, that was a tremendous presentation. Thank you so much for crunching those numbers. I feel like I have a much clearer idea now of how the economics work for community solar. I think this is going to be a really helpful podcast, especially for the communities out there that are thinking about community solar now and need to understand how this all works. So thank you so much for taking the time to do that. As always, you provide such valuable information, and I know our listeners are going to appreciate it tremendously.
Thank you so much. I really appreciate the invite to be here.
Thank you for joining us today on the Energy Changemakers Podcast. I hope today's conversation has inspired you to think differently about the role of distributed energy in our society. If you enjoyed this episode, please subscribe to our podcast on your favorite platform and consider leaving us a review. You can help us shape the dialogue around energy. Go to energychangemakers.com, subscribe to our newsletter, and join our community. Together, we can make a real difference in how quickly we can make our grid local, equitable, and clean.